Whenever we watch a rocket launch, there is always that critical call out from mission control, right?
Yeah.
Max Q.
Oh, yeah. The moment of maximum dynamic pressure.
Exactly. It is where the physical stress on the vehicle is at its absolute peak. And it is just pure, predictable physics. I mean, gravity pulls down, thrust pushes up, and you can calculate exactly what the machine can handle.
Right, because the variables are entirely visible. The engineers know the breaking points of those materials long before the countdown even starts.
But then, you step into the world of mega cap financial listings, and suddenly those laws of physics just seem to completely break down.
Yeah, they really do.
We are looking at a market landscape right now
Yeah.
that is honestly defying financial gravity.
So welcome to today's deep dive. We are dropping you right into the center of the financial world's biggest, most intense obsession, the June 2026 IPO of SpaceX, trading under the ticker SPCX.
And what an IPO it was. Right. We are talking about a company that basically bypassed traditional price discovery entirely to debut with a $1.75 trillion implied market cap. And then, just days later, it was pushing toward $2 trillion.
Which makes it the absolute definition of an engineered anomaly. A valuation that magnitude arriving basically overnight, it requires us to dissect the underlying market mechanics rather than just staring at the rockets and the launch pad.
And that is exactly our mission today. We are pulling from this really intense stack of S1 financial filings, options chain data, and analyst deconstructions to understand why SpaceX's current stock price is, well, quite frankly, an illusion.
It really is a masterclass in what we call manufactured scarcity.
Exactly. We are going to prepare you for what is mathematically guaranteed to be the largest equity supply expansion in modern financial history. But hey, before we unpack all those numbers, a quick message from you. To access more advanced researches, applications, and our latest personal deep value agents, welcome to explore and join the deepvalues.ai app. And to track total market temperature, welcome to search and download the iOS app Buffett Indicator from the Apple App Store or Bubble Watch from Google Play.
And a quick disclaimer for you before we really dive into the deep end here. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for research and entertainment purposes only and does not constitute any investment or financial advice. Conduct your own due diligence before making investment or financial decisions. Oh, and please don't forget to like this video. It's much appreciated.
Okay, so let's unpack this. We really have to start with the bizarre math of the SPCX IPO itself.
Yeah, the setup is wild.
They raised $75 billion at a fixed offering price of $135 a share. And normally, Wall Street banks spend weeks engaging in this process called book building. They pull institutional investors, test the waters, figure out a fair price based on broad market feedback.
But SpaceX just skips that entirely.
Right. But the real shocker here is the float. Out of this massive multi-trillion-dollar company, there are only 555.6 million shares actually available to trade.
And that specific number, that is the key to everything happening in the market right now. Because that float represents a mere 4.3 to 5% of the company's total equity.
Wow, so tiny.
We're looking at a microscopic supply of shares. And compounding this is a highly anomalous allocation strategy by the underwriters. 30% of that tiny available float was allocated directly to retail investors on apps like Robinhood, SoFi, and E-Trade.
30%?
Yeah, to put that in perspective, that is like 3 times the normal allocation for a mega cap technology listing.
Think about that for a second. It is like booking a massive 100,000-seat stadium for a globally anticipated concert, but you only sell 5 tickets to the public.
Naturally.
Of course, the secondary market is going to go absolutely wild. So the question is the price we see today actually real? Or is it just a reflection of starving a market that reportedly had, $250 billion in institutional demand and $70 billion in retail demand?
It is entirely a reflection of a starved market. The engineered scarcity sets a trap, really, because the market dynamics went far beyond just retail excitement. You had strict institutional mandates in play.
Right, the index funds.
Exactly. Passive index funds tracking the NASDAQ 100 were forced by accelerated inclusion rules to initiate their positions within 15 trading days of the IPO.
It's essentially a hostage situation for passive funds.
Yeah.
They literally had no choice but to buy no matter what the price was.
And worse than that, they had to buy from a pool of shares that barely existed. You have price inelastic demand, meaning buyers who do not care about the cost because their charter mandates they own the stock, colliding with artificially restricted supply.
A recipe for a squeeze.
The result was inevitable. The stock rocketed to an intraday all-time high of $225.64 in just 4 sessions before finally settling into that, $148 to $152 range.
But because the current float is so small, the eventual release of the remaining 95% of shares That is going to fundamentally break and rebuild the stock's entire market microstructure.
Which means this 5% illusion is mathematically guaranteed to shatter.
Exactly. Because the current price is built entirely on restricted supply, we have to look at the ticking clock. We're talking about the staggered release of over 12 billion restricted shares. And this isn't just one big day where everyone can suddenly sell. It is a highly choreographed cascade.
Yeah, the lockup architecture here is incredibly complex. It's designed specifically to try and mitigate the shock of all those shares hitting the market. It is bifurcated into three distinct tracks based on shareholder classifications.
Okay, let's break those down. Track 1.
So track 1 applies to employees and standard pre-IPO holders. This is a massive block, roughly 4.6 billion shares, which is about 35% of the total equity.
That's a huge chunk.
Right, and instead of a standard 180-day cliff where everyone gets their shares at once, it's staggered. It starts releasing in tranches beginning in August 2026, rolling out every few weeks until a final 100% expiration on December 8th, 2026.
And here is where it gets really interesting for you listening. There is a secret bonus trigger built into track 1 for those employees. If the stock closes at or above $175.50, which happens to be a 30% premium to the IPO price, for 5 out of 10 days just prior to the Q2 earnings release, an extra 10% of those shares unlocks instantly.
Which creates this invisible ceiling. Institutional short sellers and market makers are aggressively defending that $175 line.
Because they do not want to trigger a sudden flood of supply ahead of schedule.
Exactly. It acts as a reflexive resistance level. The market knows the trigger exists, so the market naturally pushes back against it. Then, moving on, you have track 2.
The early investors.
Right, which covers significant early investors like Alphabet, who put $1 billion in way back in 2015, along with entities like EchoStar. To prevent a total market collapse, their 1.4 billion shares are pushed entirely into 2027.
Makes sense. And finally, track 3.
The founder and executive control shares. Elon Musk controls roughly 6.4 billion shares, and his entire position is locked for a full 366 days until June 12, 2027. There are absolutely zero early release provisions for that block.
Now, looking at this schedule, especially track 1, I have to ask a critical question here. Let's look at the employees. These are rocket scientists, top-tier AI engineers. They work at SpaceX. They see the data centers. They see the launch cadence. Surely they believe in the long-term mission of the company. Why wouldn't they just hold their shares and ride it out for the next decade? I mean, why is Wall Street so certain they're going to sell?
Well, that assumes they actually have a choice.
They don't.
The assumption ignores the harsh mechanical reality of the U.S. tax code. The incoming wave of selling isn't about a lack of faith in the company's future. It is a forced liquidation event.
Oh, because of the vesting.
Yes. When these employees have restricted stock units, or RSUs, that vest, the full fair market value of those shares, becomes ordinary income on their W-2 immediately. The income tax is owed right then to the IRS, regardless of whether they sell the stock to get the cash.
Okay, wow. So they have to sell some shares just to cover the tax bill on the shares they received. But I imagine the situation is even more precarious for the earliest employees holding incentive stock options, or ISOs, because the spread is just so huge.
It's massive.
I mean, they might have a strike price of $13.50 from an award back in 2017, and suddenly the stock is trading at $150.
And that spread is where the real danger lies for them. While exercising an ISO isn't taxed as standard ordinary income, it heavily impacts the alternative minimum tax, or AMT, calculation.
Right, the AMT.
At these historic valuations, an early engineer exercising their accumulated ISOs could easily face an AMT liability exceeding $1 million in a single tax year.
That is insane. So they're basically holding million-dollar tax grenades, and the lockup expiration is the pin getting pulled. The moment they are legally allowed to trade, they absolutely must sell to generate the cash to pay the government.
Precisely.
But this forced selling by SpaceX insiders won't just affect SpaceX. When billions of dollars are sucked out of the market to absorb that SpaceX stock, where does that cash actually come from?
Yeah.
And this brings us to the macroeconomic ripple effect.
Yeah, we are looking at a textbook case of dual opening dynamics that will drain liquidity from other assets. Let's start with the bearish overhang, which will dominate the third and fourth quarters of 2026. The looming fear of all this incoming supply actively suppresses the stock price. Even if SpaceX announces incredible fundamental news, say a flawless Starship payload deployment or a massive AI data center contract, institutional buyers will hesitate.
Because they know what's coming.
Exactly. They know a wave of tax-burdened employee selling is right around the corner, so they refuse to buy the good news.
But then there's the flip side of that, right? The bullish overhang that kicks in after December 2026.
Yeah.
You have trillions in institutional capital that actually thinks the roughly $2 trillion valuation is too steep right now, so they're just waiting patiently on the sidelines for the December dip.
Right. They want in, but cheaper.
Once that employee supply hits the market and gets absorbed by these massive funds, the relief of that pressure could actually trigger a structural rally.
And that absorption is largely mandated by how indices are built. Let's look at index mechanics. Indices like the NASDAQ 100 use what's called float-adjusted weighting. To put it simply, indices only base their weightings on the shares that are actively available to trade. They do this so that passive funds aren't forced to buy highly illiquid stock. Right now, SpaceX is weighted based only on that tiny 555 million share float. But as the lockups expire, the legal float mathematically expands by billions of shares.
Meaning, if I am a passive index fund at Vanguard or BlackRock, my rules literally force me to buy more SPCX simply because the tradable float got bigger. The underlying company hasn't changed at all, but my mandated exposure just multiplied.
Yep, mechanically forced to buy.
So to buy those billions of dollars of newly available SpaceX shares, portfolio managers might have to sell off shares in Apple, Microsoft, or Nvidia just to fund their mandatory purchases.
That is the exact liquidity drain the broader market is bracing for. If the insider selling outpaces the mandatory passive buying, capital must be reallocated from elsewhere. It creates localized selling pressure across the entire mega-cap technology sector. And if we pull back to look at the cross-asset correlations, we really have to look at what quantitative funds call the Tesla dynamic.
Oh, please explain how that works, because Elon Musk is the clear through line here.
Well, quants don't view these as separate companies. They view Elon Musk's entire empire as a single unified pool of capital. The S-1 filing revealed that Tesla actually invested $2 billion in XAI, which converted into roughly $3.7 billion worth of SpaceX stock at current valuations.
Wow, okay.
Because XAI is intertwined with both, when institutions are forced to buy SpaceX, algorithms automatically short Tesla to hedge their Musk exposure. They are creating this mechanical seesaw effect between the two stocks.
It proves that you don't even need to trade SPCX directly to feel the impact of its market gravity.
Yeah.
Okay, so once we get past December 2026, the lockup expires, the artificial scarcity vanishes, and passive funds have rebalanced.
Yeah.
Suddenly, this stock has to plummet back to earth if the underlying financials can't support it.
Oh, absolutely.
If you're listening to this and wondering how a company with a $41 billion deficit is somehow valued at $2 trillion, you aren't crazy. The market has temporarily decoupled from reality.
We need to talk about GAAP accounting, which is really just a strict financial framework that says, look, let's stop talking about future narratives, visionary hype, and adjusted metrics, and start looking at the actual, undeniable cash moving in and out of the bank.
Let's run those actual numbers from the S1.
Right.
The underwriters achieved a multiple of around 100 times its trailing 2025 revenue. They brought in just over $18.6 billion. To put that in perspective for you, SpaceX generates less than a tenth of the revenue of Amazon, but it entered the public market at a valuation higher than Meta and Tesla combined.
Yeah, and to understand why, you have to break down that $18.6 billion. You find a business model acting like two entirely different companies living under one roof.
Right.
First, you have Starlink, the satellite internet division. This is the undisputed cash engine. It generates 61% of total revenue, so over $11 billion, and it is the only segment that prints consistent, verifiable profit.
So upstairs, Starlink is printing cash. But even there's a catch. The S1 notes that Starlink's average revenue per user actually fell 18% down to $81 a month.
Yeah, the ARPU is dropping.
Because they're heavily discounting their hardware and subscriptions to capture lower-priced global markets. High volume, but contracting margins. Meanwhile, downstairs, they're basically setting that cash on fire. You have the space segment, commercial rocket launches, and government contracts.
Right.
Despite holding 90% of the global commercial launch market, this segment operated at a $657 million loss.
Driven almost entirely by the massive $3 billion research and development price tag for the Starship program. But the ultimate vulnerability, the real anchor dragging on the valuation, is the artificial intelligence segment.
The XAI absorption.
Yes. Following the absorption of XAI and the Grok models, the AI division posted an operating loss of over $6.3 billion in a single quarter.
A single quarter.
This was fueled by a staggering $12.7 billion in capital expenditures just to build out compute infrastructure. By Q1 2026, the consolidated net loss for the whole company was $4.2 billion for one single quarter.
Pushing their total accumulated deficit to $41.3 billion.
So what does this all mean for the actual fair value of the stock?
Yeah.
We have wildly diverging views from the analysts on this. On the bull side, you have Aswath Damodaran from NYU, often convened evaluation.
Sure.
He says a $1.25 to $1.3 trillion market cap is actually fair value. He's looking past the current burn rate to focus on 45% future space launch margins and the massive total addressable market for owning the physical infrastructure of AI.
But then traditional analysts like Morningstar take a much darker view of the cash burn. They assign a fair value of $780 billion. That is a 55% drop from the IPO price, putting it right back at the December 2025 private tender valuation.
A huge haircut. Yeah, they argue that if the company continues to normalize running at a $16 billion annualized net loss, institutional investors will demand a massive discount to absorb the flood of unlocked shares, forcing the valuation back down to standard discounted cash flow metrics.
Which perfectly explains why, right now, insiders and institutions are fighting a quiet, intense war in the options market. Because of that terrifying gap between the $2 trillion narrative and the $41 billion deficit, smart money is utilizing complex derivatives to protect themselves. Let's look at the options chessboard.
The options flow maps perfectly to the lockup timeline we discussed earlier. Let's start with the insiders, those employees with the looming tax bills. They are deploying a specific architecture known as a zero-cost collar.
Okay, so they need an insurance policy. They buy a put option to build a floor, say, guaranteeing they can sell it at $130 no matter what.
Exactly.
But long-dated put options on a highly volatile stock are wildly expensive. The only way tech employees can afford that premium out of pocket is if they sell away their upside to fund it, right?
That is the exact mechanism. They buy the protective put at the $130 strike, expiring in January 2027. To pay for it, they simultaneously sell a call option at the $180 strike. The premium they collect from selling the $180 call perfectly offsets the cost of buying the $130 put.
Wow, brilliant.
They willingly sacrifice any upside above $180 to guarantee they don't lose everything below $130.
And because thousands of SpaceX employees are doing this exact same trade through institutional brokers, it creates an ironclad resistant ceiling. All those sold calls at $175 and $180 act like a physical lid on the stock price.
But what about the institutions? How are the heavyweights playing the timeline?
Well, for January 2027, right after that massive employee cliff unlocks, institutions are executing a fascinating maneuver. They're selling massive blocks of $135 puts.
Selling them.
Essentially, they're getting paid massive premiums by terrified retail investors to promise to buy the stock at its original IPO price during the December dip. They're getting paid to be the buyers of last resort. Getting paid to buy the dip. I love that. And then they use that collected premium to buy far out of the money $380 calls, betting on a massive long-term AI breakout once the supply shock is completely over.
Then we jump forward to June 2027, when Elon Musk's 6.4 billion shares unlock. The strategy shifts entirely. Institutions are aggressively buying $150 and $95 bear put spreads, which is a structured bet that the stock will experience a sharp decline.
Betting the stock goes down. But wait, Elon isn't going to just dump 6 billion shares on the open market, right? He'd lose total control of the company, and it would crash the price of his own asset.
Oh, he almost certainly won't sell a single share. But the institutions are betting on the machines.
The algos.
Yes, when those 6.4 billion shares legally transition from restricted to free float, it drastically alters the denominator for countless valuation metrics across the market. The bet is that algorithmic quantitative models will mechanically sell off the stock as they adjust their risk models to account for the newly massive public float. They are front-running the algorithms.
Incredible. But this raises a question about something you found in the S1 options data. There is a bizarre anomaly out in 2028, the 2028 duration trade. On July 8, 2026, an institution sold 17,200 put contracts at an $80 strike for December 2028.
Yeah, that one stands out.
Wait, I need to stop you there because the math on that feels incredibly dangerous. If the market is terrified that the stock could crash under the weight of 12 billion unlocking shares in a massive cash burn, well, selling an $80 put 2 years out feels like standing on train tracks to pick up a $20 bill while a bullet train is coming. If it drops below $80, they are on the hook to buy billions of dollars of a crashing stock.
It looks like an insane risk until you really dig into the yield mechanics. With the stock near $150, the $80 strike is deep out of the money. They collected $16.80 in premium per share for taking on that risk.
Got it.
Since selling a cash-secured put requires posting the $80 strike as collateral, collecting almost $70 on $80 collateral yields, an immediate 21% return on margin. Spread over the duration of the trade, it's an annualized yield of roughly 8.6%.
So they aren't even trading this like a high-growth tech stock. They've built a synthetic high-yield bond.
Exactly. The institution is acting as a premier insurance provider to a terrified market. By selling that $80 put in such massive size, they're publicly declaring that a sub-$80 valuation, which equates to roughly an $800 billion market cap, is a fundamental impossibility.
You're calling the bottom.
They believe that Floor is entirely, irreversibly backed by the physical monopoly of the Starlink network infrastructure in low Earth orbit. No matter the cash burn on rockets or AI, the satellite network alone justifies that floor.
So synthesizing this whole journey for you, the listener, right now, as you watch SpaceX moving on your screen, you have to understand that SpaceX isn't actually trading on its rockets or its orbital payloads or its massive AI ambitions. Not yet. It is an illusion, trading entirely on supply mechanics, algorithmic index inclusions, and the unforgiving IRS tax deadlines of its early employees.
Right.
But by early 2027, all of that artificial scarcity will evaporate. The gravity of the broader market will return, and SpaceX will be forced to justify its historic, unprecedented valuation through rigorous, cold, hard cash flow fundamentals.
And when the dust finally settles on this 12 billion share supply shock, I want you to consider this. What if SpaceX's ultimate role in the public markets isn't just to be another high growth tech stock? What if its true legacy is to act as a massive permanent baseline for how the global economy prices the intersection of physical space infrastructure and artificial intelligence? If they can normalize running at a $16 billion annualized loss to build the physical backbone of the future, they might not just rewrite the rules of aerospace gravity, they might permanently rewrite the rules of valuation for everyone else.
Well, from max Q in the upper atmosphere to a totally new definition of financial gravity back down here on Earth, that is something for you to keep your eyes on as we move through the chaos of 2026. Thanks so much for joining us, taking the time, and going on this deep dive with us today. See you on the next one.